Hey, it's Darius. Did you fail the CPA audit exam? The scores are out, and if you're trying to pass audit, it's likely that you need a better understanding of these topics. Now, the good news about audit is that much of it can be learned relatively quickly with good instruction. Where it slows down, though, where you need particularly good instruction, is assertions. Let me ask you this. In an audit of financial statements, who makes assertions? A, the auditor, B, the audit client, C, both, or D, neither? And the answer is B, the audit client. In an audit of financial statements, it's the client making the assertions. The auditor then uses those assertions in gathering evidence to determine if the financial statements are fairly presented. So let's take a closer look at assertions, starting with completeness. We know that it's the client that makes assertions, not the auditor. What does the client assert with regard to completeness? Well, the client asserts that all transactions and events that should have been recorded have been recorded. With completeness, the auditor is concerned that some transactions that should have been recorded have not been, and if so, the books are not complete for the year under audit. So with completeness, the auditor's concern is understatement, that transactions may not have been recorded and they should have. For example, purchases should have been recorded, but they were not, and that would understate purchases and the related accounts payable. The opposite of that is the existence occurrence assertion, where the client asserts that all transactions and events that have been recorded actually did occur in the period under audit. With occurrence, the auditor's concern is that some transactions that were recorded have not occurred yet, such as sales transactions. So with occurrence, the auditor's concern is overstatement. Overstatement of sales, overstatement of the related receivable from the sale. The auditor's concerned that if the sale was recorded and it had not occurred yet, then not only is the revenue overstated, but so are the receivables. If the sale did not occur, the receivable does not exist. And that's why you often see existence occurrence listed together as one assertion, because the client is asserting that any sales that were recorded actually occurred during the period under audit, and for that reason, the receivable from those sales actually exist at year end. The auditor is concerned that if the sale was recorded and it had not occurred yet, then not only is the revenue overstated, but so are the receivable, because if the sale did not occur yet, then the receivable does not exist yet. And the auditor knows that the easiest way for a client to overstate net income and cook the books is to overstate sales, which would also overstate receivables. So when you see existence with occurrence together, existence tends to relate to the balance sheet accounts of assets, liabilities, and equity, whereas occurrence tends to deal with the income statement accounts like revenue and expenses. And that should make sense, because if the sale hasn't occurred by year end, then the receivable from that sale doesn't exist and should not be on the balance sheet. All right, here's an example of a question you may have missed on the exam. Which of the following is being asserted by the audit client regarding whether all assets, liabilities, and equity interests that were recorded actually should have been recorded during the period under audit? And it's a little wordy, right? So what is the client asserting here? Completeness, 1. Existence, 2. Both, or neither? And the answer is B, 2 only. With existence, the client asserts that all assets, liabilities, and equity interests that were recorded are valid and actually should have been recorded. With existence, the auditor is concerned that some assets that were recorded on this year's balance sheet should not have been recorded because the sales from those receivables have not occurred yet. So the answer is existence. If it would have said existence/occurrence, that would have been correct also. What's wrong here is completeness. Because completeness, the client asserts the opposite. The client asserts that all transactions and accounts that should be included in the financial statements are indeed included. Completeness ensures that no assets, liabilities, or equity interests that should have been recorded have been omitted, and the client asserts that the books are complete. So this question asks, which of the following is being asserted by the client regarding whether all assets, liabilities, and equity interests that were recorded actually should have been recorded? And the answer is existence. So the answer is B. Let's try this question. Also on assertions, a little bit wordy. The auditor is concerned that some transactions and events that should have been recorded were omitted by the client. The auditor is concerned with which of the following client assertions. Is it A, completeness, B, existence occurrence, C, both, D, neither? And the answer is A, completeness. With completeness, the client asserts that the books are complete, that all transactions that should have been recorded have been recorded, and nothing has been omitted. The auditor's concern with completeness is directly related to ensuring that no transactions or events that should have been recorded were omitted. If anything's been omitted, such as liabilities, then the books are understated, they're not complete. 2 is wrong. Existence occurrence, that would be relevant if the auditor was concerned with whether the recorded transactions and events actually took place, if they were valid transactions, or if the recorded assets and liabilities actually exist. But it does not address the concern about omissions. This question asked about the auditor being concerned that some transactions and events that should have been recorded were omitted by the client, and the answer is A, completeness. Here's one they could ask you. With the existence occurrence assertion, the client asserts what, and as a result, the auditor is concerned with what? All right, existence occurrence, the client asserts A, that all transactions that should have been recorded have been recorded. No, that would be the completeness assertion. And B says that also. All transactions that should have been recorded have been recorded. No, A and B are out. How about C? What's the client asserting with existence occurrence? Is it all transactions that have been recorded are valid? Yes. And as a result, the auditor is concerned with understatement? No. D must be D. All transactions that have been recorded are valid? And as a result, the auditor is concerned with overstatement? Yes. Letter D is correct. With existence occurrence, the client asserts that all recorded transactions and events actually took place. They're valid. They occurred. The auditor would be concerned with overstatement because the risk is that transactions may have been recorded that did not actually occur, and because of that, there's overstatement of revenue, of accounts receivable. So this question asked, with the existence occurrence assertion, the client asserts what? And we said that all transactions that have been recorded are valid. That's what the client is asserting with existence occurrence. And as a result of that assertion, the auditor would be concerned with overstatement, that if some of those recorded transactions haven't actually occurred yet, worst case scenario is that revenue and assets would be overstated. Letter D says it best. And if you need more help passing the audit exam, go to i75cpareview.com and get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference.